Minimizing the taxes that we pay as UK investors is absolutely critical to maximizing our investing returns. But the UK government has several plans in place to make investors pay more tax in every way possible, which could literally cost us hundreds of thousands of pounds in the long run. But what they don't want you to know is that there are a few nifty tricks that you can still use to pay as little tax as possible. So I'm going to show you everything that you need to know to minimize the investing tax that you pay to keep your money in your pockets and out of riches. But just to make it clear, you should know that I am not a financial advisor, so I am by no means a tax expert, and you should not take my word for gospel. I'm just a random guy trying to do my bit. Right then, let's crack on. So the government are making some changes in the upcoming tax years, which are going to result in us lot paying more investing taxes. The first blow is to our capital gains tax-free allowance, which currently sits at £12,300 per year. That means if you sell an investment outside of an ISA and you make a profit of up to £12,300, that is currently completely tax-free. However, starting in April, this tax-free allowance is going to drop down to 6k, and then the April after that, it's going to drop down to 3k. Then we're going to do a similar thing to our dividends tax-free allowance, which is the amount of dividends that you can receive before you have to pay tax on them. Currently, you can receive up to £2,000 tax-free, but in April it's going to drop to £1,000, then the April after that, it'll drop down to 500 quid. And these changes wound me up so much that the other month, I decided to email Rishi myself and tell him my thoughts. I've given him my number and told him to call me, but he's not got back. We'll see what happens. Of course, the simple answer to avoiding these tax-free allowance cuts is to make sure that you're investing inside a stocks and shares ISA, where you can invest up to £20,000 per year tax-free. Speaking of which, I've partnered up with InvestEngine, the low-cost ETF investing platform for UK investors. If you sign up using my link in the description, you'll receive £25 when you deposit your first £100 on the platform. Also, any new customers who either fund an InvestEngine ISA or transfer over an existing ISA with at least £10,000 before the 2nd of May will qualify for an additional £100 investment bonus on top of the £25 sign-up bonus. They offer general investment accounts as well as stocks and shares ISAs, and if you choose to invest with their DIY portfolios, you will pay almost no costs. The only fees that you have to pay are the ongoing charges of the funds that you choose to invest in. It's got a slick, easy to use interface, an app for phone users, over 550 ETFs to choose from, as well as easy to read analytics for your portfolio. Remember to sign up using my link below for your £25 bonus. I'll put the terms and conditions in the description. Cheers. Now, if we go back to stocks and shares ISAs for a minute, there is actually another problem on the horizon. It's rumoured that stocks and shares ISAs might soon be capped, as the think tank Resolution Foundation suggested that ISA limit should be capped at 100k, meaning that any growth over that inside an ISA will be subject to tax. So as investors, it feels like we're being attacked from all sides, with tax-free allowances being cut and now rumours that ISAs are going to get hit too. Hello?
Mr. Speaker.
Rishi? Well, first off, you can call me Lewis. What's all this about investing taxes then?
The party opposite, honourable gentleman, has finally realised that spending does need to be paid for.
Oi, don't sass me like that. And who's that cheering in the background? I'll tell you what, I'm going to find some ways around these taxes. Mark my words.
That's what's weak, Mr. Speaker. He has no principles.
No principles? You son of a bitch.
Many hours later.
So I've had some time to chill out and to look into this tax business, and I've found a few secret tricks that are gonna save us thousands. First of all, it's worth saying that despite the worry of the ISA limit being capped, it is still a great investment tool, and you should prioritize investing in that over investing in a general investment account. But if your ISA is maxed out, then you can use this next trick to make sure that you get the most out of your tax-free allowance before it is reduced. Because you can use up the £12,300 tax-free allowance that you have before April 5th by selling any stocks or shares that are outside of an ISA, and then you can just buy them back at a later date. As long as you don't profit more than £12,300 when you do this, this is going to be completely tax-free. This is what is known as a bed and breakfast deal. Just note that if you want to buy the assets back, you can't buy them back within 30 days, because this breaks the 30-day rule, which basically just stops you from abusing this trick. It just means that you can't buy back very similar stocks or shares within 30 days. So let's say you invest in an S&P 500 accumulation fund, you can't sell that and then just repurchase the income version of that fund because they're too similar. However, let's say that's a Vanguard fund, you could sell that Vanguard fund and then reinvest in an iShares fund that also tracks the S&P 500, and that is counted as different because it's a different provider. So if you do a bed and breakfast deal, you're going to absorb those capital gains before April. Then on April 6th, you get a brand new 6k capital gains tax-free allowance. You can then repeat this process next year, but just know that the allowance is then going to be dropped down to 3k. You can also increase your allowance by realising any losses that you may have made in previous tax years. But don't worry, because you don't have to have reported those when they happened, you can still claim for them up to 4 years after the end of the tax year when they occurred. So let's say that you sold an investment for a loss of £1,000 3 years ago, you can now call upon that loss and offset it against any gains that you make this year, which effectively ups your limit by £1,000. But before you even have to think about doing this, it could be worth considering investing in your pension. You can either do this by upping your contributions at work or by opening a self-invested personal pension. The benefit of investing in a SIPP is that you get a tax refund on any money that is invested in there. So assuming you pay 20% income tax, when you deposit and invest money into your SIPP, you're going to get a 20% bonus to start you off. If you're a higher or additional rate taxpayer, you can claim this refund too in your tax return. Just know that it won't be added automatically. You can invest up to 40k per year in a SIPP, which is double that of an ISA, and you can actually contribute more if you didn't fill it in the previous 3 tax years. The downside to SIPPs is that when you eventually draw down from them in retirement, you will have to pay tax on those drawdowns in the form of income tax. So deciding whether to invest in a SIPP or an ISA can be a difficult choice to make. If you invest in a SIPP, you're essentially investing pre-tax money because of a tax refund, which means that it has more potential to grow, but then you eventually have to pay tax on it in the future. But when you invest in an ISA, you're investing money that's already been taxed, but when you eventually draw down from that, you don't have to pay any tax on it at all. I do have a video where I go through some of the maths on this, but if you're still unsure, then I'd recommend you talk to a financial advisor. But if we assume that you're all capped out on your ISA and your SIPP, and fair play to you if that's the case, then we can combine these two tricks to do what is known as a bed and ISA or bed and SIPP deal. This basically involves realising any capital gains that are made outside of a tax wrapper, but then with those gains, you deposit them into an ISA or a SIPP, which really helps you squeeze the absolute most out of your tax-free allowances. Another tip, which applies to you if you're married or in a civil partnership, involves transferring any assets to a spouse or your partner. These transfers are tax-free as long as you live together, which means that you won't have to realise any capital gains when you do the deal. Your partner, assuming they still have their capital gains allowance free to use, can then dispose of the asset and the capital gains count under their name, which can effectively double your limit. And with that, I've got a message to send. Yo, Rishi, you're screwed. Told him I'd win. Another strategy that I haven't mentioned would be to just talk to a financial advisor, especially if you have a complex financial portfolio with various assets under management. Even though you probably will pay a fee for this, they could find ways to optimize and minimize the amount of tax that you pay, so it could just pay for itself. I know that some people are reluctant to pay for this sort of thing because it can feel like a step backwards, but the value is definitely there and it is not an option that should be ignored. It's Rishi. He said, "You win this time, check this out though, lol." Then he sent me a link. Let's see what it says. You just can't win, can you? Even after you've minimized the tax that you pay as an investor, if you really want to get the best investment returns, then you can't just settle here. There are actually a few more things that you need to combine with this, because without this knowledge, you could end up losing tens of thousands of pounds without even knowing. And that's why you really should watch this video here, because it's going to show you how to avoid making the most detrimental investing mistakes that everybody is making.